If you have access to this type of account in your retirement savings account, it's your lucky day. Why is that? Stay with me. So I'm talking about something called an after-tax 401k account. And after you watch this video, I would like you to go into your current company's 401k webpage, whether it's Fidelity, Morgan Stanley, E-Trade, wherever there is a 401k account. And I want you to look closely at your 401k contribution page. Now, for most people, you just see traditional 401k. You may see Roth 401k if you're lucky, but super lucky people will see something called an after-tax account. Most people ignore it. They ignore it at their own peril. It's actually something that can be used to turbocharge your retirement savings. Well, let's talk a little bit more about that after-tax account and why people who have after-tax accounts in their 401k plans are super lucky. So a lot of people don't know this, but besides the traditional 401k and the Roth 401k, there is a third option called an after-tax 401k account. Now, not everyone has access to the after-tax 401k accounts. Some employers give access to employees. Some employers do not give access to employees. I've worked for companies where I've had access, and I've worked for companies where I did not have access. And typically, when they don't give access to employees, it's a question about the 401k plan provisions and making sure that it's compliant with IRS rules. But if you do have that after-tax account in your 401k plan, this means that you can pretty much turbocharge your Roth retirement savings. So if you have access to the after-tax 401k, the first thing that you want to do is call the after-tax 401k account holder, whether that is Fidelity, Schwab, or another third-party company, because you need to know the rules and provisions that the companies have put in place on that after-tax 401k account. Sometimes they limit the amount of money that you can contribute every year to that after-tax 401k account. It may be 10,000, it may be 25,000, but typically companies do put some sort of limit on that after-tax 401k account. Now, the power of this account is that you can make after-tax contributions throughout the year and then transfer that money over to a Roth IRA and turbocharge your Roth IRA savings. You can also take that money before you're 59 if you please, but it will be taxed and you will be penalized because it's technically in a 401k account. Most people do not take that money that's sitting in the 401k after-tax account. They take it and roll it over at some point during the year to a Roth IRA account. Now, in setting this up, you do want to ask some questions. Number one, how much can you contribute? Two, do they have auto distributions to the Roth 401k account? Sometimes you don't even have to do anything. As soon as you put money into that after-tax 401k account, within a few days, the system is set up to automatically move the money over to your Roth 401k account. If that's the situation that your company has arranged, then it's very easy peasy. Sometimes companies set it up that way, but sometimes companies don't. And if you find out that your company has not set up an auto deposit into your Roth 401k account, what you have to do essentially, and usually they allow for this provision once a year or maybe twice a year, is that you have to call the company that is the holder of that after-tax account, and you have to roll that money directly into a Roth IRA account that is set up in your name. Now, you want to keep track of this and you want to do it because while the contributions are after tax and not taxed, the growth on the money will be taxed. And if you do it every 6 months or every year, hopefully the growth will not be that severe where you'll end up with a huge tax bill. But if you forget to do it, let's say you've been contributing to an after-tax account for 5 years and suddenly there is a considerable amount of money in that account and considerable amount of growth, you might be looking at a hefty tax bill. So I do advise that you have to keep track of the after-tax account, how much is in it, and make that move once a year or twice a year if you don't have automatic setup where there is an automatic disbursement to the Roth 401k account. One additional thing that you have to track closely in the after-tax accounts is basis. Basis meaning the original amount that you put into the 401k or the after-tax 401k that you already paid taxes on, and that isn't going to be taxable by the IRS. And when that money moves from the after-tax 401k into the Roth IRA, you want to keep track of that basis. Why is basis so important? Well, something that's special about this maneuver, moving from an after-tax 401k to a Roth IRA, is that you really have access to your basis at any point in time, even before you are age 59 and a half. So let's say $50,000 of an after-tax account is basis, and you move that $50,000 along with the growth over to the Roth IRA, you have immediate access to that $50,000 of basis. Now, it's kind of a widely known secret, but I don't tell my clients that this is available to them. Why don't I tell my clients? I don't want people using the Roth IRA as a savings account. It's much more effective as a retirement account. And if you're constantly dipping into it for projects, for bills, for home down payment, etc., it kind of loses its potency over time. So only in the most clutch situations where clients really do need money will I reveal that they can actually go into their Roth IRA if they can prove basis on the money that they placed into the Roth IRA. But it has helped in a handful of situations, namely when putting a deposit or a down payment down on a home. It has helped people with emergencies that come up in life. But I do recommend using that very cautiously. And when you take that money in from the after-tax 401k and you place it into the Roth IRA, you consider it a done deal that you're not going to touch until age 59 and a half, and that is money set aside for retirement. But I do suggest keeping track of basis in case something absolutely calamitous does happen and you need to access the basis money for that emergency. Now, I have had situations where clients inadvertently ignored after-tax accounts and they ended up with quite a substantial amount of money that was going to end up being taxable to them in that year. If they didn't want to pay the taxes or they couldn't pay the taxes up front to the IRS, we could split that money between a traditional IRA and a Roth IRA. So basically all the growth on that money, let's say over 5 years that person had, I don't know, $25,000 worth of growth on that money, that would go into a traditional IRA. The rest of the money, the initial contributions, let's say that person had, I don't know, $50,000 in initial contribution, we would move that money into a Roth IRA account. So there is a way around it. Who are the people who are best suited for after-tax accounts? Well, first things first, if you're using the after-tax account, typically, pretty much in all situations, you have maxed out your 401k. Now, only 11% of Americans actually max out their 401k accounts. So you can see by what I'm saying that being able to really take full advantage of the after-tax account is relatively rare. Second thing, you pretty much have to be a high income earner because you have to max out that 401k and you have to have excess money after tax to place in this after tax account. You have to wait until you're 59 and a half. This is not a good plan for people who need the money immediately. If you take the money out before age 59 and a half, it could be penalized for an early withdrawal. And you also have to be diligent about following up on this account. This account does require some active management in that you have to watch the amount of money in the account and move the money into the proper Roth IRA once or twice a year. You can't let that slip or else you'll end up with enormous gains that have to either be paid in taxes or have to be siphoned over to a traditional IRA account. So there you have it. After you watch this video, please go into your company's 401k plan and check the situation to see if you have access to an after-tax account. Now, this may require a conversation with your accountant and with a financial advisor, but if you're looking at the account and you're maxing out your 401k and you want to do something more, well, the after-tax account may be right for you. So tell me what you think. Tell me what you like, tell me what you don't like. And if you found this information useful, please like, share, and subscribe.